FA1 Part A. Introduction to Transaction Accounting. Chapter 3. Recording, summarizing, and posting transactions. The topics that this presentation will cover are 1. Recording business transactions. 2. The day books. 3. The general ledger. 4. Posting from the day books. 5. The sales and purchase ledger. 6. Control accounts. 7. Accounting for sales tax, VAT. 8. Methods of coding data. 9. Manual and computerized systems. 10. Batch processing and control totals. 11. Accounting systems. 12. Accounting modules. 1. Source documents are the source of all information recorded by a business onto their accounting system. For a list of the types of source documents and where they are recorded, see the table on page 51 of your interactive text study guide. Stop the lecture. Answer the questions on page 51 and 52 of your interactive text study guide. The receivables ledger or the payables ledger is where you would find the summaries of all transactions with individual suppliers or customers, so that a net amount due or owed can be calculated. In the general ledger, the receivables or payables control accounts are where you would find the summaries of all transactions with all suppliers or customers, so that a total amount of receivables and payables can be calculated. 2. Day books are also known as subsidiary journals. They are the books of prime entry, which is where a transaction is first recorded from a source document. The sales day book, sales journal, records invoices sent out to credit customers. The sales return day book, records when customer returns goods. The purchase day book, purchases journal, records invoices received from suppliers. The purchase return day book, records credit notes received due to goods returned. The cash book, records all monies in, and all monies out. Bank statements, are statements issued from the bank. The petty cash book, is a record of the cash float. Stop the lecture. Answer the questions on page 59 of your interactive text study guide. 3. The general ledger, is also known as a nominal ledger. It contains a summary of all day books, and all the details of assets, liabilities and capital, income and expenses and therefore profit and loss, of the business. It consists of a large number of ledger accounts, each account with a different purpose, and a different name. Transactions are posted to the general ledger from the books of prime entry. Posting means entering transactions from the books of prime entry into the ledger accounts in the general ledger. 4. When we post from the sales day book to the total receivables account, the total amount invoiced is debited to receivables account, and credited to sales account, and the sales tax, VAT, due is credited to the sales tax account, VAT account. In order for us to know who owes us what amount, we have a set of separate accounts for the individual customers, in a memorandum receivables ledger. Memorandum means that it is not part of the double entry system. When we post from the purchases day book to the total payable account, the total amount invoiced is credited to payables, and debited to the different expenses, and the sales tax, VAT, claimable is debited to the sales tax account, VAT account. In order for us to know who we owe what amount to, we have a set of separate accounts for the individual suppliers, in the memorandum payables ledger. Memorandum means that it is not part of the double entry system. In the sales day book, there is a separate column for discount allowed, or cash discounts given to customers. It is a memorandum column, it has nothing to do with the actual monies being received. The discount allowed column is needed to show why the full amount was not received by a customer. A list of the debts owed, is recorded in the receivables ledger. The individual discounts allowed will be posted to the individual ledger accounts in the receivable ledger, so that it clears the total amount that is owed to the business. 5. General ledger accounts are accounts that relate to the type of transaction, rather than the person involved. That is why they are known as impersonal accounts. Personal accounts include details of individual customers and suppliers, which are in the receivables ledger and payables ledgers. They do not form part of the double entry system, they are memorandum accounts only. The sales or receivable ledger consists of a number of personal receivable accounts, one for each customer. These accounts enable the business to keep track of how much an individual customer owes at any time. These are some reasons for keeping personal accounts for customers. A customer will phone or email the business, wanting to know how much he owes. The staff need to be able to answer him. Personal accounts are kept, so that statements can be sent to customers at the end of the month. On the statement, it needs to show how much is owed at the beginning and end of the period, any new invoices sent out, and any payments received from the customer. The managers of the business will want to keep a check on the credit position of individual customers, to ensure that no customer is exceeding their credit limit. And personal accounts are kept, so that payments received can be matched against debts owed. When receivable ledger accounts are written up, entries in the sales day book, when a customer buys goods, are debited to the customer's account. Entries in the cash book, when a customer pays his account, or the sales return day book, when a customer returns goods, are credited to the customer's account. Each customer account is given a reference or code number. This reference number is entered in the sales day book and the cash book. Using the reference numbers, amounts from the sales day book and the cash book are posted to the receivables ledger. The purchases or payables ledger consists of a number of personal payables accounts for suppliers. All transactions in the purchase day book and the purchase return day book are recorded in the individual supplier's accounts, in the payables ledger. Any amount being owed to a supplier will be entered in as a credit. Any payment to a supplier will be a debit entry. 6. Control accounts are accounts in the general ledger, which record the totals of similar but individual items. The total in the control account should agree with the totals of the individual accounts, and act as a check for accuracy, that all the transactions have been entered in correctly. A receivables control account records all receivables transactions. It contains all the totals posted from the sales day book and the cash book. The total of the control account should agree with the totals of individual balances in the receivable ledger accounts. A payables control account records all the payables transactions. It contains all the totals posted from the purchases day book and the cash book. The total of the control account should agree with the totals of individual balances in the payable, purchase, ledger accounts. Stop the lecture. Answer the questions on page 67 and 68 of your interactive text study guide. 7. The business doesn't keep the output sales tax, VAT, that it charges, it pays it to the tax authority. Therefore the records of sales should not include sales tax, VAT. In South Africa, the tax authorities are SARS. All the sales tax, VAT, that is needed to be paid by the business, is paid to them. Sales tax, VAT, is accounted for when it first arises. When recording credit purchases or sales. In the day books, there is an analysis column to separates the output or input tax, VAT, from the sales income or purchase cost. When the account is paid, there is no need to show the sales tax, VAT, in the cash book, because the input and output tax, VAT, was recorded when the sale or purchase was made. When recording cash paid or received in cash transactions, the sales tax, VAT, on cash sales or purchases is analyzed in a separate column of the cash book. The output tax, VAT, from a cash sale will be credited to the sales tax, VAT, account, and the input tax, VAT, paid on a cash purchase will be debited to the sales tax, VAT, account. The tax paid to, or recovered from tax authorities, SARS, will be the balance on the sales tax, VAT, account. Debit entries on the sales tax, VAT, account are total input tax, VAT, in the purchase day book and on cash purchases. Credit entries on the sales tax account are total output tax, VAT, in the sales day book and on cash sales. 8. Each account in an accounting system has a unique code to identify it for posting. For an example of coding, see the table on the screen. Coding saves time in copying data because codes are shorter than longhand descriptions, and it also saves storage space on a computer for the same reason. Significant digit codes are codes with some digits within it, which describes the item being coded. For an example, see the table on page 73 of your interactive text study guide. Coding needs to be correct. If the coding is not correct, the information will end up in the wrong accounts and there will be errors in the accounts. Stop the lecture. Answer the questions on page 73 of your interactive text study guide. Manual accounting systems are handwritten books, for ledgers and day books, subsidiary journals. Computerized accounting systems are accounting software on a computer. All computer activity can be divided into three processes. Input, which is entering data from original documents. Processing, which is posting books, ledgers, and sorting the inputted information. Output, which will produce any report desired, including financial statements. Stop the lecture. Answer the questions on page 74 of your interactive text study guide. Computerized accounting systems perform the same tasks as manual systems. The following are the differences that arise. How the information is stored, in computer files rather than in books. How tasks are performed, by accessing a function through a menu option rather than entering in by hand. How some computer packages do things automatically. See the next video for the rest of Chapter 3.